Google is currently trading at historically low valuation levels. In this video, we will analyze every relevant business segment and explore why the market seems to underestimate the company. First segment, services. Is it dying through AI? The swift rise of generative AI is a big risk for Google's core business. New tools like ChatGPT, Perplexity, and Claude might change user behavior, shifting attention from traditional web search towards more direct conversational solutions. As a response, Google is aggressively embedding its in-house AI model, Gemini, into its already existing search and advertising business. They are, for example, offering AI overviews, which directly summarize, state sources, and answer queries without having to leave the Google site. This shows that Google is iterating quickly and is trying to capitalize on their massive ecosystem. But more importantly, ads have now been implemented into the overviews, which protects their massive advertising revenue stream. This is a big step, as this is the first big monetization of a large language model. This new approach is, however, also risking lower ad effectiveness, as users might be happy with the provided information of the summary and therefore don't click on the links and sources provided. This could in turn lead to less clicks and impressions, which might lower ad revenue for some sites. The global digital advertising market is expected to achieve growth rates ranging from 9% to 15% per annum in the next years. With these expectations, we get an average market growth assumption of 13.2% per year. Google is currently achieving margins of approximately 40% in this segment. Second segment, cloud. Unlimited growth? Google's cloud has emerged as a clear third position in the global race for the cloud infrastructure market. As of Q1 2025, AWS leads with 30% market share, followed by Azure at 20% and Google at 10%. Microsoft and Google were able to expand their market share in recent years, while Amazon and other providers struggled. The market growth rate for the cloud segment is anticipated to be between 16% and 25% in the next years. This gives us an average expected market growth rate of 20.8% per year in the cloud segment. Google's margin in this segment is at 17.7% as of their latest quarterly earnings. AWS was at 39% and Microsoft's intelligent cloud segment at 41%. Third segment, Waymo. Finally, a winning bet? The US robo-taxi market shows Waymo as its leading player because of its fast-growing operations. The company now performs more than 250,000 paid rides per week, according to mid-2025 data, which represents a significant growth from its initial 100,000 rides in early 2024. The sensor and lidar-heavy fleet of Waymo comes at a cost premium compared to Tesla's lean camera-only robotaxi strategy. This could benefit Tesla in the long run if they make it work. A Waymo car is rumored to cost between $130,000 and $150,000, while Elon Musk is claiming that a robotaxi, aka Cybercab, will cost approximately $30,000. We will see if Elon delivers on his promises for once. As mentioned, they are scaling rapidly. For 2026, they plan to more than double their active cars to over 3,500. Wells Fargo is projecting the company to capture 10% of the US rideshares market over the next 5 years. And the bank expects Waymo to grow its rides from the current 18 million per year to 465 million in 2030. Lyft and Uber rides have an average price ranging from $14 to $15. As of now, customers are willingly paying more to drive in a Waymo. For our analysis, we still assume an average trip price of $14. With these two assumptions, we can predict these revenues for Waymo in the next 8 years. After 2030, I assumed a trip and revenue growth rate of 50% per year. While this sounds very high, it is a meaningful reduction of the approximately 92% per year that Wells Fargo is suggesting with the 2030 target. Considering that Waymo cars are doing more than 1 billion trips per year in 2032, we now need to factor in the costs needed to achieve such stunning metrics. As mentioned before, one Waymo should cost somewhere between $130,000 and $150,000. This will probably decline once the company scales and is buying equipment in large quantities. Just to be safe, we nevertheless stick to the assumptions. Using the current numbers, Waymo is achieving 1 million trips per month with 1,500 active cars. This means each car is accomplishing 666 trips per month. By assuming this rate and a potential improvement to a rate of 900 trips per car per month, Waymo needs to invest $12 to $19 billion in the next years. To be honest, this doesn't seem too bad considering that Google is already burning approximately $17 billion each year in their other bets category. Assuming an average cost of $140,000 per Waymo car, as well as 666 trips per month per car, we get the following cost per year, as well as an EBIT indication. The EBIT is improving very quickly as Waymo only needs to pay for new cars, while the already existing ones continue to generate revenue. After analyzing each relevant business segment, we can now jump into Google's valuation. As a first scenario and as our bear case, I assume that the whole services segments achieves no growth for this next 8 years due to increasing competition from AI. Even with these very pessimistic assumptions, Google is currently trading in the fair value range. Within our bull case scenario, we assume Google to grow at market growth rates for the services and cloud business, as well as the successful scaling of Waymo. With these realistic and conservative assumptions, Google is currently undervalued by up to 80%. Conclusion: Google is facing a potential disruption in its services segment. I, however, believe that they are best positioned to utilize AI and integrate it into their already existing business model. As you can see from our bear case, Google is even fairly valued if the services segment stops growing. By anticipating the market growth rates for the services as well as the cloud segment, Google is currently undervalued by up to 80%. A potential Waymo ramp-up is the cherry on top. It is a very promising venture, but for our time horizon, it just influences our valuation a tad. We will have to see how the ramp-up really develops and especially how future growth, profitability, and competition look. With all this in mind, I currently rate Google stock a strong buy. What's your perspective on Google? Do you use these prices to buy? I am currently also buying PayPal and Taiwan Semiconductors. You can see my reasoning behind these two picks in these two videos here. See you in the next one.